For the policy, insurance policy, parties to contract, the person responsible for making payments for a policy is the policy owner, while the insured is the person whose death will trigger payment of the death benefit. The owner and insured may or may not be the same person. For example, if Joey buys a policy on his own life, he is both the owner and the insured. But if Jane, his wife, buys a policy on Joey's life, she is the owner and she is the insured. The policy owner is the grantor and they will be the person to pay for the policy. The insured is a participant in the contract but not necessarily a party to it. The beneficiary receives policy proceed upon the insured person's death. The owner designates the beneficiary, but the beneficiary is not a party to the policy. The owner can change the beneficiary unless the policy has an irrevocable beneficiary designation. If a policy has an irrecoverable beneficiary and beneficiary changes, policy assignments or cash value pouring would require the agreement of the original beneficiary. In cases where the policy owner is not the insured, also referred to as the CLOE, QEVIT or CQV, insurance companies have sought to limit policy purchases to those with an insurable insert in the CQV. For life insurance policies, close family members and business partners will usually be found to have an insurable interest. The insurable interest requirement usually demonstrates that the purchaser will actually suffer some kind of loss in the CQV dies. Such as requirement prevents people from benefiting from the purchase of purely speculative policies on people they accept to die. With no insurable interest requirement, the risk that a purchaser would murder the CQV for the insurance proceed would be great. In at least one case, an insurance company that sold a policy to a purchaser with no insurable interest, who later murdered the CQV for the proceed, was found liable in court for contributing to the wrongful death of the victim. Liberty National Life v. Welcome 267 ALA 171 1957 Contract Terms. Special exclusion may apply, such as suicide clauses whereby the policy becomes null and void if the insured dies by suicide within specified time, usually 2 years after the purchase date. Some states provide a statutory 1-year suicide clause. Any misrepresentation by the insured on the application may also be grounds for nullification. Most of states, for example, specify maximum constability period of no more than 2 years. Only if the insured dies within his period will the insurer have a legal right to contest the claim. On the basis of misrepresentation, request additional information before deciding whether to pay or deny the claim. The face amount of the policy is the initial amount that the policy will pay at the death of the insured or when by the policy matures. Although the actual death benefit can provide for greater or lesser than the face amount, the policy matures when the insured dies or reaches a specific age, such as 100 years old. Cost, insurability, and underwriting. The insurance company calculates the policy prices at a level sufficient to fund claims, cover administrative costs, and provide a profit. The cost of insurance is determined using mortality tables calculated by actuaries. Mortality tables are statistically based tables showing expected annual mortality rates of people at different ages. As people are more likely to die as they get older, the mortality tables enable insurance company to calculate the risk and increase premium with age accordingly. Such estimate can be important in taxation regulation. In the 1980s and 1990s, the SOA 1975 to 1980 basis select ultimate tables were the typical reference point, while the 2001 VBT and 2001 CSO tables were published more recently, as well as the basic parameters of the age and the gender. The newer tables include spread mortality tables for smokers and non-smokers, and the CSO tables include spread tables for preferred classes. For more videos, please like and subscribe my channel. Thank you.